Okay, let's get started. Okay, good morning, everyone. Today we are very happy to have Bertold Herendorf as our guest speaker. Bertold is a leading expert on development economics and in particular on structural transformation. And today he's going to present his paper, Structural Change and Markups Evidence from the National Accounts. Welcome, Bertold.
Thank you, Shitsan, for the kind introduction. So this is joined with Benjamin Bridgman, who is the vice chief economist of the Bureau of Economic Analysis. So I should say all we say, or I say, has nothing to do with what they think and believe and so on and so forth. So the nice thing about working with somebody from the Bureau of Economic Analysis is he's actually also the guy who is responsible for producing the national income and product accounts. So not only does he know how to use them, he makes them. And so everything we do has a lot of credibility, I hope, through that. Let me start with the motivation. There's a lot of recent evidence, mostly for the US, on market power. The most common measure of market power is markups. And there are two strands of the literature. One strand uses microdata from CompuStat. And they find that there were large increases in markups, which they interpret as large increases in market power. Another strand of the literature uses aggregate data from NIPA, the National Income and Product Accounts, and they find more modest increases in markups. We were consumers to this literature and just looked at it. I saw a few papers presented here, Ben saw a few at the BA. And when you see this, you kind of ask yourself, how can these two things be true at the same time? So the question in general that we have or had is, why is the micro evidence using CompuStat so different from the macro evidence? When I say so different, they get hugely higher increases in markup. So sometimes they go from 15% to 30, 40%, whereas the macro papers, they go from 10 to 15, 17. So this is not like tiny stuff. This is hugely different increases. And so then to get started, and since I know a lot about this, we thought about structural change in this context, and we asked a more specific question, which is, what is the effect of the sectoral composition and its changes on aggregate markups? So that's the question I mostly will answer today. And in doing so, I think I will also give you some ideas about what the gap between the micro and the aggregate data might be. But the strict formal analysis is about the second question. Now, there's at least for us, was a challenge in answering the questions. And that is, it's really hard to calculate markups. The micro studies, they measure markups as the price over the marginal cost. So if you are under perfect competition, price equals marginal cost, there's no markup. If you have some market power, you can increase the price over the marginal cost, and the higher the price over marginal cost is, the higher is the markup. Looks all good when you do microeconomics and look in a textbook. The problem is, when you go to the data, this is very sensitive in what you think is a variable input that affects your marginal cost. I mean, think about it like this. Some things, like capital investments, you put in place maybe for half a year or a year only. So if you have a short horizon, like a few weeks, then this is a fixed input. But if you take a longer horizon, like a year or two, it's a variable input. So you can see how, if you want to get really high markups, you just make sure that you get very few variable inputs, go on a daily basis. There's not that much that you can vary and everything becomes very sensitive to the frequency with which you measure it and what is the variable input. Now, the advantage of the macro studies is they usually don't do that because they go by annual data. But then their challenge is to split what's left after you pay labor. So I've written it here. PY is the total GDP or income, if you want. And WL is what you pay to labor. Now that residual you can measure very carefully, but now you got to split it into payments to capital and profits. If the profits are zero, in perfect competition, the profits are zero, so PY minus WL is just payments to capital by definition. But now, if you assume that there is some market power, you can no longer make that assumption. So you have to somehow calculate RK in order to come up with an estimate of pi, the profits, and then you can calculate markups. Now that is sensitive to what R you use. And so which bond rate you use, is there risk premium, whatever. And so what we are doing here is trying to address this problem in a hopefully good way. In particular, what we do is we split the pi y minus WL, meaning the residual after labor is paid, by adopting a method that's model-based, and it's due to a Brookings paper by Fari Gurio in 2018. Now, if you don't know that paper, don't worry, I'll explain it. If you don't understand that, if you know that paper and don't understand it, don't worry either, because it's almost impossible to understand. I was happy there was a lockdown, so it took me forever to understand it. I'll explain the essence of it and how to use it in this context later. So no pre-required knowledge here. We then use the National Income and Product Accounts, NIPA, to calculate aggregate and sectoral markups for the private U.S. economy. And we speak to the effects of aggregation on the economy-wide markups. Here's what we find. We start in 1980, mostly because everybody else does. Since 1980, markups increased at the aggregate level from 11 to 15% for the private U.S. economy. So the level and the increase are smaller than what the micro-literature estimates, and they're consistent with what Fari Gurio and other people, at least in terms of order of magnitude, estimated. From that, we calculate that the estimates of the micro-literature are not well suited for answering macro questions. And one reason comes in the next result. We show that composition matters a lot for aggregate markup. In particular, the level of the markup differs considerably among different parts of the economy. So one way I will illustrate that is by just leaving different parts of the economy out. I take real estate out, or I take real estate and finance out. And you see very big differences when you do that. A second way in which I will explain that is I would show that changes in the composition matter for changes in aggregate markups, and there the structural change trick comes in. It's always the same trick in every single stupid paper. Structural change reallocates resources to the services sector. And it turns out the service sector has lower markups, so you measure fairly big and increasing markups in the goods sector, which much of the micro-literature focuses on. But when you aggregate, that doesn't translate one-to-one into large and increasing markups at the aggregate level, because there's this other sector where things are very different. So a different way of saying that is a lot of the micro evidence, it seems to us, is not representative of the whole economy. Think of the big corporations in the US. Many of them are manufacturing firms. So they are in the goods sector, and then there's a lot of markups in the service sector, which you don't get if you look at CompuStat, that usually has listed firms only. But if you want to talk about aggregate questions, they are important because they have a pretty big weight in the economy. So that's basically what you should take away from that. So that was my introduction. If anybody has a question or a comment, now is a good moment. You.
Okay. Yeah, sure. Okay, so I got the title of the paper a couple of days ago. I thought you were like using like the micro approach, then there was some issue, right? There was the older issue. I mean, if you wanted to use the micro approach, then you need to, I guess, separate out the prices versus the quantity of the output. And it's almost impossible to do that for services, right? I mean, for services, it's even...
That's only one problem.
Yeah, I mean, sure. That's one issue, right?
You need to find a price and a quantity, and you're exactly right.
Right.
Quality problems for services. Education, think of education in the US, sure. And it ranges from $10,000 to $50,000 for a year in a college. So what's the quantity?
Yeah.
Right, and what's the price? I completely agree with that. But on top of that, it's very hard to come up with the marginal cost.
Sure, yeah.
So you have price and marginal cost are somehow hard to measure. Now, the advantage here is, that's why we don't do the micro approach.
Sure.
We're going to use some very standard equations that describe the aggregate and use what they imply. So markups are basically backed out in a system of equations. It's 3 or 4 equations, which is very simple. And you can solve it for the aggregate at the sector level. So that problem won't be there.
Yeah. I think the macro approach is the only way to like estimate this markup thing for services, I guess. I mean, it's almost impossible to do that if you use this like a micro approach.
Actually, that's a good point.
Yeah.
Okay, I'm writing this down. Thank you, Shitson. Anybody else?
Okay, second, I have another question. Okay, second one. So both you and me know this like this Prescott business, right? This intangible capital. So how does this intangible capital fit into your framework?
Okay, so that's a good question. I wonder who you taught you economics. Anyway, let's be serious. So it's a very good question. The first part, there's two parts to the answer. The first part is the data we're using from the BEA includes part of intangible capital because intellectual property product is now part of the capital stock.
Yeah, right. Yeah.
Okay, so intellectual property product is copyrights, it's patents, it's that kind of stuff, and that's part of the capital stock, and that's in the analysis we do.
Right.
Now, everybody agrees, in particular, if you ever was exposed to at Prescott, that there is more intangible capital than just intellectual property product.
Yeah.
That additional intangible capital we don't include because it's not in the data that we use. But previous studies have actually thought about that. And it turns out it affects the answer, but not dramatically. So what happens? Imagine there's something missing, some intangible capital somewhere.
Sure.
So what you have to do is you have to add this to the capital stock. And then the income that you get from this capital, you have to add that to GDP. And if you go through the whole derivations, the numbers change somewhat, but it doesn't completely destroy everything. So we ignore it here, but you can do it. Now, if you're more interested, you can ask me later.
Yeah.
So some people have actually gone through the deliberations and added it and thought about it. But here's the problem with that. It's not so clear. If you don't see it in the data, it's not so clear what to infer.
Yeah, sure.
Exactly. So it's a lot of imputation, and we didn't want to do this.
Yeah. I mean, in the micro literature, there is one issue, right? I mean, they don't know whether this markup thing, that's like intangible capital, that's the rent to intangible capital, or just like a totally monopoly. I mean, they can't like tell these two apart.
Yes. But by the way, in some sense, that's also true for us. You see that later.
Okay.
So, but hold off with that when you see the model.
Yeah.
But that's also a good point, and let's talk about that once I go into it a little bit.
Okay. Yeah.
So is there anybody else who wanted to ask? That's not the case, then I'm going to go into the model. So I said we use Fari-Gurio, Brookings paper 2018 version of the growth model. What they did is they wrote down a one sector growth model with disaster risk and monopolistic competition. Now, the disaster risk is there because they wanted the risk premium in the model, and it generates that. The monopolistic competition is there because they want markups, right? If they had perfect competition, there would be no issue. Now, I should say right up front, the disaster risk is an elegant way of generating a risk premium, but it's just one way. There could be many other ways in which the risk premium could be generated. And you'll see later on in the calibration, it doesn't really matter where it comes from. I just wanted to write down a model where I get a risk premium. But what we read off the data is the risk premium for anything that could have generated it. So that's kind of an advantage. Now, then they derive model relationships that allow them to estimate aggregate markups. So what we do is we write down a multi-sector version of the growth model. Today, or for the purpose of the presentation, only 2 sectors. You can make that into as many sectors as you want. We're going to distinguish in particular between goods and services. And we have a disaster risk and monopolistic competition in each of these, which gives us sector-specific risk premium and sector-specific monopoly power. And we also allow for sector-specific Cobb-Douglas production functions. Now, what this is literally a translation of this existing paper into a multi-sector world, and the model relationships allow us to estimate aggregate and sectoral markups. Now, for now means for today, I'm going to give you the value-added version. There is a gross output version with an input-output structure in progress, but it doesn't work right now. And I think it's not my fault. So I'm just going to dump Ben under the bus. So there's some issues we have with the gross output version and bringing it to the data. So what's the difference? We are going to assume that the goods and the service sector produce value added, and that's aggregated up to final output, which equals value added. A more interesting world is where the goods and service sector produce gross output, and part of that is delivered to final users, and part of it is delivered to the goods or service sector themselves and to the other sector. Why is that interesting? Because now you get what's called double marginalization. So the markup gets charged every time something gets used, and the inference of what contributes to distortions or markups at what sector is somewhat different, because it doesn't only depend how much value added the sector produces, but also how much intermediate inputs for other sectors it produces. Let's make it really concrete. Imagine one sector is super distorted and produces a small final output component only, but a lot of stuff for everybody else. That distortion now propagates to the whole economy, and the input-output structure, if you do it right, you can trace it. And so that sector has a much bigger impact on the aggregate markup now than you would otherwise conclude. The good news is the aggregate results are the same as in the gross output version. I showed that. So this is just how much you attribute to what sector. I won't be able to tell you today, so I'll do the value-added version. Disaster risk. So in order to get this off the ground, we're going to use an Epstein-Zinn lifetime utility. If you have never seen this, this is a little more involved than the usual one. To fix ideas, just imagine you had sigma equal to 1. So the sigma would go away everywhere, and you have the standard recursive value function where the value today is the CT to the 1 is CT, it would be linear then, plus the continuation value tomorrow. And now the continuation value is somewhat different from what you usually have, because there's a theta in there which allows you to get a coefficient of relative risk aversion that's separate from the sigma. What does the sigma govern? That's the intertemporal elasticity of substitution, or the inverse of it. In the usual specification that we always use is one parameter for the intertemporal elasticity of substitution and the relative risk aversion. And what this specification does is it separates it, but that's about it. Right? So, in particular, if you set the theta equal to 0 and rearrange stuff, you can get the standard separable intertemporal utility function that we always use. Okay. Final goods production, final output or final goods Y, which is going to equal GDP, is a Cobb-Douglas aggregator of value added from the goods and the service sector. And two exponents, phi G and phi S, add up to 1. Goods and service production, in turn, that's where the monopolistic competition comes in. So in each of these different sectors, J, you have a Dixit-Stiglitz aggregator, which goes from 0 to 1. You aggregate intermediate inputs. Ji is kind of annoying to indices, but what it basically is for the goods sector, J equal G. You take different varieties indexed from 0 to 1 by I. You combine them to a Dixit-Stiglitz aggregator, and the key is that the elasticity of substitution, epsilon J, is sector-specific. Why is that key? Because I want potentially different monopoly power and different markups in the two sectors, and the different epsilon J's are going to give me this. Okay. Now, to your question from before, Shitzen, there is an exogenously given number of firms from 0 to 1 in each sector. And so they have and the Dixit-Stiglitz aggregator is such that the substitution elasticity is larger than 1. So they have some monopoly power, and they will find an optimal price, and they make pure monopoly profits. Now, your question was very good, actually, because you said, so how do I interpret the resulting markups? In our paper, they're pure monopoly rents. But you could imagine a more general environment where you have entry. So then these markups lead to monopoly rents, or profits, I should say, and you use these profits to pay for fixed cost that you had to incur before to actually enter the sector. Then you could have free entry and there's nothing left on the table. In particular, you can't eliminate the monopoly profits because then nobody enters anymore. Okay, so we won't have anything to say because we force it to be a pure monopoly rent here. But the data is consistent with the other interpretation as well. Okay. Intermediate goods production, it's a Cobb-Douglas of capital and labor. Each variety Ji uses a capital stock and K and labor inputs L. It's a Cobb-Douglas of the capital and labor, and the exponent on capital depends on the sector in which you are, meaning it depends on J. There are two productivity terms. One is Z and one is A. Z is just going to be a sector-specific deterministic TFP trend, which we're going to use to fix, for example, the relative price. And then there's A, and A is what Varigurio use to introduce the disaster risk. So that's a random walk. AJ equal in period T equals AJ in period T minus 1 times the exponential of a shock psi. And you should think of this psi as being a sector-specific disaster shock that occurs only very rarely. So every period you draw between 0, a positive shock, and a disaster shock. You might not ever see it in the data, but that will lead to a risk premium. if you invest in this sector. Okay, and that's how they get their risk premium in the model. So this is literally taken from their paper. Capital accumulation, standard thing. Take today's capital, it depreciates, so the undepreciated part is 1 minus delta K. Invest X. Now we want to capture the fact that the price of capital is falling, which corresponds to the quality of a given unit of output that I invest is increasing. So over time, Q is going to increase with a deterministic trend. So over time, the invested X is going to be translating into more and more capital next period. And then there is this goofy epsilon term at the exponential term at the end. So this is the same psi as before. So what that actually says is if a disaster shock happens, then the capital stock is going to adjust immediately. So why is that there? Because otherwise you can't solve the model. So what that does is it shuts down the transitions. So imagine there's a good shock. If you have a good shock, let's go to the previous one. If you have a good shock on A, you want more capital in this sector because you have effectively more labor. What this specification says is you immediately get that new more capital for free. So you basically can have a balanced growth path where nothing ever deviates in terms of transition and goes back. And that makes everything analytically computable, or means we can analytically calculate it. Again, this is one-to-one from Fari-Gorio, and it's kind of a trick for convenience. Now, we're going to calibrate stuff to 15, 20-year periods. So the transition is not something we think is super important here. I think that's why this is fine for now. Usually adding up constraints. Capital in each sector is integrating overall firms. Labor in each sector, labor in total is integrating overall firms in each sector and then summing it up. And the total labor endowment is normalized to 1. Total output, you can use it for consumption or investing in either one of the two capital stocks. And rewriting this here, solving it for investment, gives you this equation, which is going to be important later. And it basically says how investment evolves. So it's the standard thing, except for two things. One is there's the quality improvements, and the other one is then there's this disaster shock, which immediately adjusts your capital stock so that you don't have any transitions. Okay, before I describe the equilibrium, any questions are fine. That's the model, basically. Everybody on board? So I'm not going to go through all the glorious details. Let's just talk about the basic features that are key here. The first is there are sectoral production functions, and they're both Cobb-Douglas, and they're going to aggregate to an economy-wide Cobb-Douglas production function. Now, I should point out that this is not generally the case in a world like ours. Why? Because these alpha exponents are not the same in both sectors. But what we're going to do is we're going to look at balanced growth paths, where on each balanced growth path, there's no structural change. So that all the proportions, everything is constant. And then even two Cobb-Douglas production functions with different exponents going to aggregate to one aggregate production function with an aggregate exponent. So that's nice. The disaster risk implies a risk premium, and the risk premium in our application is specific to each sector. And we're going to calibrate it to each sector as well. There's perfect competition in the final goods and the goods and service production. And there's monopolistic competition in actually, I got this kind of wrong. So there's perfect competition in final goods and in the intermediate goods production, and there's monopolistic competition in the production of the total value added in goods and services. Okay. Nothing too exciting there. And then the different substitution elasticities in J equal either goods or services, they lead to different sectoral markups, and the markup turns out to be epsilon over epsilon minus 1. So keep in mind, epsilon is the substitution elasticity. It has to be a little larger than 1, because if it was smaller than 1, then the problem would not be well defined. Why? Because if the substitution elasticity is smaller than 1, they want to choose arbitrarily small prices. Right. Arbitrarily small quantities, because they want to choose arbitrarily large prices. And then you need some entry or something to discipline how low they can go with the quantity and how high they can go with the price. So if there's no entry threat, then you need the case where epsilon is larger 1. So the markup is epsilon over epsilon minus 1. Okay.
But just to clarify, so is this epsilon J going to be constant over time?
Yes. For now, yes.
Okay.
So another good question. Looking ahead, we will connect this model to the data, and we will assume that there are different periods or different balanced growth paths. So along each balanced growth path, the epsilon J will be constant, but since we are thinking about changes in markups, across balanced growth paths, the epsilon J's are different. Okay, the same thing here. I mean, think about sectoral production functions aggregate to economy-wide Cobb-Douglas. The aggregation is on a given balanced growth path is the same, but on a different one may be different. And so the exponents of the aggregate may be different on the other balanced growth paths. But that's the only way in which we can solve stuff. By the way, in many ways, this is exactly like what Fari and Gurio did as well.
Okay.
So sometimes it's not totally satisfactory. In many models, you have like a balanced growth path, and then there's structural transformation along the balanced growth path. Here you have one balanced growth path without any. You have another one, and then you just do comparative statics across the two.
Okay.
And on each of them, epsilon J and also the markups are constant, but across the different ones, it's not.
Okay. Then how should I think of the changes in this epsilon J? So what happens?
It's entirely exogenous in the analysis. And I mean, it's okay. So why would that happen? I guess something has to change that's not modeled. So for example, imagine there's more market power for some reason for the firms. In order to match that, you have to increase epsilon J to get a larger markup. But the model doesn't tell you anything exactly about this underlying reason. Okay. It just tells you. So in some sense, it's purely accounting or purely telling you what happened.
Okay.
And not why it happened.
I see. I mean, because in the macro trade literature, they usually take that as like a deep parameter, like a preference parameter, which do not change over time, because I mean they have another way to aggregate that, right? They put that in the utility function. So
true. I mean, my nasty response is they take it as a deep parameter which doesn't change within one paper. But if they write another paper, that deep parameter often is a different parameter. So speak of us as two papers. One is about the first balanced growth path, and one is about the second one. But on a more serious, I totally take what you're saying, and it's not entirely satisfactory. So here, let's go back. The alpha will be different across balanced growth paths. Again, that's an exogenous change. I don't know where it comes from.
Yeah.
And the epsilon will be different. So these are in the technology, not in the preferences. But we're not saying. And by the way, the phi's are going to be different as well.
Oh, okay.
because the weights of goods and services
changes over time. Sure.
If you want structural change, the weight of goods is going down. So in the second balanced growth path, the phi better be smaller, otherwise there's no structural change. So we're using the model in a consistent way, but there's a lot of stuff that's fairly reduced form, and that's for measurement purposes.
I see.
Okay, let's see what we learn from it. There's going to be a very sharp conclusion at the end. But if you're interested in deep modeling, I don't think this is going to help too much. It's just going to speak to how can we go from sectors to the aggregate.
Yeah.
The other thing is you got to keep it simple, otherwise I can't solve it. Although I have worked a lot with these models. And the nice thing is we have closed form solutions to everything. So you can speak about the aggregation. Cool. You don't have to simulate stuff. And I'll show you in a minute, it's going to be a system of very few, very intuitive equations. And there's your answer. But let's press ahead, then I'll get there.
Okay.
Unless somebody else asks a question too. Okay, now risky balance growth path. So we're going to denote by PK the price of capital relative to the nomoria final goods. Final goods are nomoria. Sorry, I just said that final goods price is 1. And we're going to denote by rho the expected rate of return on capital in sector J, rho J. So then a risky balance growth path is essentially a balanced growth path where in expected terms, everything grows at a constant rate and actually will grow at the same rate. So in particular, output, the value added of both sectors, the value of the capital stock in both sectors, investment, consumption, and wages grow at the same expected rate, except for this occasional stupid disaster risk. Then you get it, and then everything keeps on growing. But in expected terms, you expect that to be 0. And the capital allocation is constant, and the rental rate in appropriate units is constant as well. So it's a standard balanced growth path with this disaster risks sneaked in so that you get a risk premium, but everything else you can solve. Remarks, what makes the balanced growth path risky is that the common growth rate is stochastic, comprising both a deterministic trend and this occasional stochastic level shifts. Since each risky balanced growth path has a constant, I just said that before already, sectoral composition, we'll study structural change by comparing sectoral compositions across risky balanced growth paths. We'll assume that on each balanced growth path, the sectoral trends are constant and the trend for the quality improvements of capital is constant as well. Now, before I do this, since you asked, Shitzan, and you were close to actually uncovering this as well, this is all elegant and convenient and nice. There's one problem with it, which is as follows. Imagine I have a trend that goes like this. So what I'm going to do is I take an average here and I take an average there. And now I say from this average to that average, it's 10 percentage points down, which is a lot less than from the beginning to the end. Right? So if you have a long trend, since you take averages, this is what we are finding is a lower bound of the increase in markups. I think that's a fair critique of that approach. Calibration strategy, calibrate to the private U.S. economy without real estate. Now, why without real estate? Because it's a weird sector. It's a sector where half of the value added generated is imputed to owner-occupied housing. It's also a sector where markups are outrageously large. And I haven't figured out exactly why that is. My hunch is that land is not properly valued. I don't know whether you knew that, but if you go to NIPA and you take the capital stock, land is not formally part of the capital stock. Although I'm not always sure how they take it out. But now what that means is that if one important input is not measured, then the markups are too big. So this is not us being sneaky. Everybody essentially takes real estate out. Okay. So then we assume that different subperiods represent different risky balance growth paths, define structure of change as the change in the sectoral composition across the risky balance growth path. Calibration. So this is shows you how simple everything is once you look through all the bells and whistles. There are 4 parameters to be calibrated, and then we are done. The first is the general trend. You take that directly from the data on each risky balance growth path. So we take the average growth of GDP. And in the second period, this is going to go, including the Great Recession, we stopped in 2007, and to say that was the average. Then delta plus the growth rate of quality of capital, you can think of this as physical plus economic depreciation. Why? Because the growth rate of capital quality is inversely related to the price. So if the capital quality grows, the price of capital falls. That's economic depreciation. So if you buy a piece of capital and the price goes down in the future, that's as if that thing depreciated, but economically, and then delta is the physical depreciation. We calibrate that given GT from the investment capital ratio, which we can see and can solve in closed form solution. I haven't even written it out here, but that's a simple formula on the balance growth path. So we know what delta J plus GQ is. And then the really important and challenging thing for everybody else was what was the expected return on capital. Now, why is that important? Because nobody exactly knows what the right reference interest rate to take is. Many people take some bond rate, but then bond rates have almost fallen to zero, whereas firms claim that their financing costs aren't zero. The approach of Farigurio points out that the Gordon growth formula says that the price to profit ratio of a sector, and this is obviously only for listed firms, is the present value of all future payments. The price is the present value of all future profits. Along the balance growth path, profits grow at 1 plus G. If you discount with the expected interest rate or expected return on capital rho, you get the standard formula where the price equal 1 over rho minus G times the profits. And this is just due to a timing that you have a 1 plus GT in here. The timing here is you only get it next period. Having said that, we can see the price profit ratio at the sector level. I forgot who, somebody at NYU has it on in their webpage. So this is what Ben uses. GT we got before. So if you see P over Y, P over pi and GT, you can infer what the reference expected rate of return on capital has to be. And once you know that, you are in business, because what are markups? Take the total revenue in a sector and divide it. Sorry, this is value added. The total value added in a sector and divided by the payments to capital and labor. Labor we see, WL. Capital, it's the user cost essentially, which is physical plus economic depreciation plus that rho. So as soon as I know rho and I know delta Q, I know what the payments to capital and labor are. In a competitive world, PY equals those. If there's monopoly power, PY exceeds it, and the markup is exactly the ratio of the two. Now, notice one really cool thing that sold me on that approach. And by the way, I'm just basically doing Farigurio at the sector level. So this is not, I mean, I didn't invent that. But one thing that really sold me, when I went to the beginning, and said, we're using this Epstein-Zinn, you can separate you can separate sigma from theta. One is intertemporal elasticity, the other one is risk aversion, gives rise to risk premium, all good and fine. When I go to the calibration stage, none of these parameters shows up here. So I can do the calibration without taking a stand on sigma. and without taking a stand on theta. One way of reading this is to say, well, this calibration is true at this fairly aggregate level, sectoral aggregate level, no matter where the risk premium comes from. As soon as you know what the rho is, it's going to include it. Okay? And so for that, you have to believe the P-pi ratio. Now, obviously, the big assumption is going to be that P-pi tells you something about all firms in a sector, not only about the listed firms, which is a big if. So if the rho is different for the stock market firms from the non-stock market firms, then you have to make some adjustments. We don't do it. I don't think it's very important for our results. For now, we assume that tells you the rho for the whole sector. But once you have that rho, the beauty is it includes risk premium, no matter where it comes from.
Sorry, Bertel, so what is PF? Can you remind me what is PF?
PF is the price of the listed firms. I'm sorry. Listed firms. So F is firm. So take a representative firm in the sector. The price of the firm is the present discounted value of the profits.
Yeah, sure.
And that's pi, the profit. So if you rewrite this, price is profits on the other side, then you get the sum of 1 plus GT over 1 plus rho as a discount.
Yeah.
Okay. With some timing issue. And then you solve that with a geometric rho and you get that Gordon-Gross formula. So it's, you can think of this as price dividend or price profit ratio.
Yeah. So this is a stock price, not like the price of the product.
Yes. No. This is the stock price. Exactly right.
Yeah. Okay. I was thinking about like the issue of the price versus quantity of service. Okay.
Yeah. See, the final goods price, PY, is equal to 1. And the relative prices are PG and PS. Now, this is the price of a firm in the sector.
Okay. I see. That's a stock price, basically.
I should have said that. Yeah.
Yeah. Okay.
Sure. I'm not going to go through this. I'm going to go through this calibrated parameters. This is kind of interesting, I think, mildly interesting. We calibrate to 84 to 2000 and 2001 to 2016. Partly because this is what Farigurio do, but also partly because something really changed in 2000. So it's natural to do it that way. The alpha, which is our exponent on capitals, doesn't change at the aggregate, but look at what happened at the disaggregate level. It changes quite a bit. But if you aggregate it upright and take the structural change into account, that the weight on goods goes down, the weight on services goes up, it looks constant at the aggregate, but it's certainly not constant at the disaggregate level. Depreciation doesn't do anything. The rho fell at the aggregate level and in both sectors. Now, that's to be expected, but what's not expected is that the rho doesn't fall a lot. Most people who use a reference bond rate, thinking about the zero lower bound and how low interest rates have been, they conclude that that thing without risk premium should have fallen a lot more. And so that's the whole jazz that Farigurio get. When you do it like this, the rho falls, but not by that much, compared to imputing it directly with some reference rate. Okay. Results. So we'll do this whole thing for the private sector. Our preferred one is take real estate out. We also take fire out. We take the corporate sector without fire. And then Farigurio do a goofy thing. They take the private sector with the corporate labor share for some reason I don't understand. 84, 2000, 2001, 16. So our benchmark number is 11% markups go up to 15. That's a 36% increase. Now you can see that the numbers you get depend on what you take out. So, for example, I said real estate has outrageously high markups. If I left it in, I would get higher levels. You can also see that if you do seemingly innocuous things, like you take the whole private sector, but with the corporate labor share, all of a sudden you get a much larger increase, namely from 8% to 15%. So this is more than twice a percentage increase that you get out of markups. And the reason is that the corporate labor share initially was higher and then fell. Let me show this in a picture. So initially, the corporate labor share is higher than the aggregate economy. So this initially pushes your markups down. Then the corporate labor share falls, and that pushes your markups up. And so you get this additional effect from that. All in all, so sorry?
Yeah, so I have a question. So your time period started from 1984.
Yes.
I'm not sure about the micro papers. I vaguely remember some of those papers. I mean, they started from I think after the Second World War or something. Does that matter? No.
I'll show you. We actually do after the World War, but almost everybody starts after the 80s.
Okay. But you get.
Let me tell you one problem. Everybody wants to avoid the 70s.
Yeah.
And the reason is that inflation was super high. And if you don't do what we do or what Fari Guyer do with the roll, you immediately get into the problem that effective real interest rates were sometimes negative.
Yeah.
So if you just imagine I impute this roll by just looking at some rough data.
Yeah.
If you do this for the 70s, you're in huge trouble.
Sure.
So almost all the studies, and also I believe the CompuStat studies, they start with the 80s. I'll show you the longer horizon in one second.
Okay. So for
now,
another point. So it seems surprising to me. I mean, you estimate this row for this 2 periods, then you found similar results, because in the second period you have the tech bubble, then you have this great recession, but still you get similar results.
Yeah. Sorry, I'm going in the wrong direction. Where's my roll? Here.
Okay.
That is true. So wait a minute.
Yeah.
So row is reflecting row is falling, and it's reflecting 2 things.
Yeah,
One thing is the overall risk-free rate has fallen a lot. So if that was the only thing, you would expect row to fall a lot more.
Sure.
But now you have the tech bubble. That's a risky thing. You have the Great Recession. So what many people argue is that row hasn't fallen as much because there is some risk in the economy that has gone up and compensated it. So the net calibration result just says it fell from 7 versus 6 to 5%. Now, one thing I should highlight is if I want markups to go up, I need row to fall a lot.
I see.
Right? If row falls a lot to what that means is, the interest rates are 0. This thing goes away.
Yeah.
You divide by a lot less, your markup goes through the roof. So one reason why we don't find that markups go up so much is because row hasn't fallen so much. That was the whole Fari Guyer point. We translate that to the sector level.
Okay.
Now let me show you, Shitsan.
Excuse me, can I ask a question?
There's another question. Yeah, sure.
About the delta, the depreciation rate, it doesn't change, but we know that the use of intangible assets has been increasing. And I believe those intangible assets actually depreciate much faster than the tangible ones. So
it's even worse than this. My co-author has written a paper in Macrodynamics where he makes exactly that point. Now, I'm with you. The only thing I can say is that's what the data, where are we? That's what the data want us to do. I have no idea why that is. Now, one thing I should say, though, is we calibrate the model without real estate. So that's why this number 9 is pretty high. The second thing is this is starting in 84. So some of the discussion he had in his paper was about the 60s and 70s when there wasn't much ICP technology. Now, having said that, I was expecting delta to go up, but it didn't. So I don't know why. I acknowledge the question. It's a good one, but so one thing we did, and I don't have it here, I'll show you in a second. We also calibrate the model to the 60s, and their delta is smaller. So in that sense, it's consistent, but not here.
Okay.
So let me show you the main result, then, and then I'm done in an hour. Okay. So now we do something in addition. This is what I was just mentioning to you. We don't want the 70s, so we go and stop in 73. And we take again 16 years. So we start 57 to 73. That way we avoid the post-war turbulent period and we avoid the oil price shocks. Recalibrate the economy, and now we can ask the structural change question, namely, what would have happened if in 84 to 2000, 2001 to 16, the composition had been the same as in 57 to 73. Okay, that is the last. Now, if you look at the numbers here, the markups in goods are considerably higher and increased more than they were in services. 17 to 7, 25 to 12. So reallocating from goods to services is muting the aggregate response to differences in markups. And consistent with that, if we shut down the reallocation and just take the fixed 57 to 73 sectoral composition, what we find is that markups, aggregate markups, would have been larger in 84 to 2000 by 1 percentage point and larger in 1 to 16 by 4 percentage points. So they would have gone from 12 to 19 percentage point instead of 11 to 50. Okay, so it's considerably larger increase. So what the bottom line of that is structural change has prevented an increase in markups that happened in the goods sector to translate to the aggregate economy. Now, if you, for a first approximation, think about much of the CompuStat evidence of being concentrated in the goods sector, well, there's even in our simple aggregate framework, there's 25% markup. Now, they find even more, but at least we get up to numbers which are not totally far away from what they do. But what we find through the sectoral composition and the changes of the sectoral composition, that increase to 25% in a shrinking sector doesn't translate to the aggregate. Okay, and so that's why the aggregate only has 15%. If there had been no structural change, it would have gone up by 19. So that's the main takeaway from our paper. And now all your questions were great, Shitsam, but that's all we wanted to say. So we don't tell you why they changed. We just say, look, I mean, the key takeaway is to understand how very different numbers can coexist at the same time. And I think that's one step in this procedure where we say, maybe people have focused on a sector that had a substantial increase in markups, but that sector is shrinking. And so when you go to the aggregate, it doesn't show. That's the main point of the paper, which leads me to conclude. So what we have shown you is that markups and changes in markups differ considerably across subsets of the economies and sectors of the economies. Now, structural change is relevant here because it reallocates resources systematically to the sector with lower markups. And thereby mutes the high markups and the increases in the markups in the goods sector. Markups at the aggregate level tend to be a lot smaller than in the subsets of the economy than the literature focuses on, is the main conclusion from that.
Okay. Can you go back to the previous slide? Yeah. Okay. So so when you estimate this role for the period of 1957 to 73, you use like the listed service companies. I mean, were there any listed companies? I mean,
yeah, there were some, but I see your point. I should actually ask Ben. I haven't done that. So how many? That's a good question, Shitsan, again. How many services firms?
Right, I mean,
you have the telecommunication firms.
Sure, yeah.
You have,
yeah.
Now, one thing I should say, if you don't trust the numbers for 57 to 73, notice the only real important thing is the phi's, which we fix. So if this column wasn't there, I don't care.
Yeah, sure.
Because you can still do the counterfactual. You say freeze the shares, excuse me, 57 to 73, and then see how it affects our period here, 84 to 2000, 2001 to 16. Sure. So it's not, but yeah, I should ask Ben about this.
For this, like listed firms, listed companies, sometimes it's hard to clearly make sure, like, whether there are service companies or manufacturing companies, because they do a lot of different things, right? I mean, they could have, like, especially for the public listed companies, they have like businesses in all sorts of industries. So I guess that's something to think about. Yeah,
it's something to think about, and it's not a problem in NIPA.
Yeah,
because what they do is they're listed by establishments, but the I have to ask Ben actually.
No, I mean, for NIPA, that's fine. I mean, for NIPA, that's completely fine, because as you mentioned, they listed by like establishments, right? Each establishment could like focus on one. But for the public, I mean, when you estimate the role, right?
I agree. I have to ask Ben actually. I never thought about this much, but that's a good point. Yes.
I mean, they could like do businesses in. I guess another question is why the markups were lower in services than in the other sector. Right? I mean,
you would have thought the opposite, right?
Not.
I too.
Yeah. Okay. Okay. So I don't know why it's the case. Maybe it's like maybe there are like more larger firms in the manufacturing sector, and there are more smaller ones in services. Would that be one reason? I guess I have.
Let me give two answers. So
yeah, sure.
To rephrase your question, one question I asked Ben is, I said, the goods sector produces stuff that's tradable.
Sure.
And there's more competition. The service sector is not so tradable and there's less competition. Yeah. How come that the markups are larger in the goods sector than in the service sector?
Yeah.
Okay.
Yeah. Right.
So one answer is, if you think about these markups as covering fixed costs that you paid before, then maybe it's more expensive to set up the big manufacturing plants in the goods sector than to set up all the Starbucks in the service sector. Sure. So even with free entry, if there are fixed setup costs, and if there's free entry, that means there's no pure monopoly rents. If the fixed setup costs are larger in the goods sector, you would get our result, because you need bigger rents to cover for this larger fixed cost.
Sure.
Okay, so that's one thing which I think is not implausible. Now, yesterday I happened to read a paper by Larry Summers and some other person from Harvard who points exactly to this and criticizes the markup interpretation and offers an observationally equivalent interpretation, which is the bargaining power, the monopoly power of labor has gone down.
I see.
And they argue that you can't tell the difference in a simple reduced form model. Now, the labor story is much more plausible in that regard, because the markups in goods being higher is kind of strange. But if the labor power through unions has gone down, that happened mostly in the goods sector. But what that then means is that the firms actually have bigger rents left over that are not being paid to labor. So just to be concrete here, look at number 8. I have an arrow down. So if for some reason WL goes down in a sector, because, for example, there's no union rents anymore, that would increase the markups. Now, think of the destruction of union rents mostly in the goods sector, then the markups in the goods sector have gone up more and are larger. The destruction would say that markups in the goods sector are larger, I screwed that up. Let me do it again. If the markups in the goods sector are larger to begin with because of the big fixed cost and you destroy the union rents, you could have, despite competition, a situation where the markups you see go up, but the total rents don't go up. So what they basically argue is there's total rents and they get split between the firm and the unions. Now the unions disappear, so the firm takes more, so you measure higher markups, but it's all consistent. I haven't looked carefully into that. I'm just giving that as a possible explanation, but I think, again, it's an excellent question.
Yeah, I mean, there was a recent paper by David Alder, right, who connects the income shares, I think, labor's income share to this markup thing. I mean, there is a one-to-one relationship.
Yeah, so I see this, but so we have this too here.
Yeah, sure.
If you focus on the last 3 lines here.
Yeah.
The aggregate income share has fallen.
Yeah.
In the goods sector, it has fallen much more.
A lot, yeah. Right.
But again, the structural change means that in the service sector, it hasn't fallen so much. So the structural change, again, means that the fall in the goods sector doesn't translate one for one into the aggregate because the goods sector is shrinking.
Yeah, right.
So this is exactly the story related to the unions.
Yeah, I see. Right. Okay, I see. Right. So that, but from your data, actually, the labor's income share actually does not fall that much, right? It doesn't fall that much. No. Yeah. Okay.
But notice one thing. I mean, you go back to the formula of the calibration.
Yeah.
So if you look at the calibration, one way for higher markups is the payments to labor fall.
Yeah, sure.
Another way is the user cost of capital fall. And this is something that people have actually focused more on because they think that that's quantitatively more important. Think about like this. You start with PY, you take labor out. Okay, so you don't take so much out. There's more left.
Yeah.
But then you also have to take capital out to get the profits. And if that falls a lot because the reference interest rate is so low, then many people have argued that's actually more important than the labor part.
Right.
But you're right that there's an inverse relationship between the labor share and markups. You can just divide the whole thing by PY and you get the labor share, meaning the smaller the labor share, the larger the markups.
Okay. So my sense is that I guess this so from like your results, these markups do not have a whole lot to do with like the degree of competition or something like that. It actually has a lot to do with like investment costs or like technologies, I guess, in some sense.
I agree. Well, we can't tell you because in our model, this is just a model to measure it.
Sure.
It's not a model to explain what they have to do, but I tend to agree.
right? I mean, otherwise the services should have like higher markups, right? I mean, measured by the degree of competition. I mean, if our intuition is correct, then services, it's non-tradable. It's like more local.
I agree.
Okay.
Okay, if there are no more questions, then I'm just going to have a quick dinner and then I'll talk to a few people.
Sure. Okay.
What is it? 8:30, right? Yeah,
8:30, sure.
In an hour and 20 minutes, right?
Yeah, sure.
Okay, cool.
Okay, so any other questions? No? Okay. Any other questions? Okay, cool then. Thanks, Berto. It's a very nice talk and a very nice paper.
Thank you. And, I'll talk to you later.
Unfortunately, you can only like visit us virtually, so hopefully you can visit us sometime, like personally.
Yeah, that would be nice.
Okay.
And I'll talk to you later in the weekend, and I'll talk to the two people at 8:30. Perfect.
Sure.
Thank you. Bye-bye.
Bye.